Let me paint a picture for you. You've just landed that first real job after college. You walk into the dealership. That new car smell hits you like a promise. You see it, the perfect car, sleek, shiny, a symbol that you've made it. The salesperson smiles, runs your credit, and says the magic words, "You're approved." They focus you entirely on the monthly payment, just $499 a month. That's less than your rent. You drive off the lot feeling like an adult. This is success. You tell yourself you deserve it. You worked hard. It's a practical necessity. For the next 6 months, 8 years, that payment is just a normal line item in your budget, or an accepted cost of living. But what if I told you that car isn't an asset? It's a rapidly depreciating liability the second you sign your name. But what if I told you that normal $500 payment isn't just costing you $500 behavior? But what if I told you this single culturally approved decision is the primary engine quietly ensuring millions of people will never, ever build real generational wealth? This isn't just about cars or transportation. This is about a systemic trap, a silent tax on the middle class, vacuuming your future wealth before it even has a chance to grow. My name is Bobby, and I spend way too much time thinking about how normal, everyday financial decisions silently steal our future. If you're someone who feels like you're working hard, but the net worth number just won't budge, or if you've ever looked at a car payment and thought, well, everyone has one. Or if you've ever wondered why building wealth feels so impossibly hard despite doing everything you're supposed to do, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today, we aren't talking about cars. We are talking about the single largest wealth destruction machine sold to the American middle class. We're talking about what I call the wealth vortex behavior. Here's the thing about car payments. Conventional wisdom says they're a normal, necessary part of adult life. They tell you it's just the cost of reliable transportation, that you can afford it if the monthly payment fits your budget. But that advice ignores a fundamental, brutal truth. That logic focuses you on the symptom, the monthly cash flow, to completely blind you to the disease. And the disease is the catastrophic compounded opportunity cost. The payment is just the smoke. We're here to talk about the fire. To understand this trap, we have to go back to where it was engineered, Detroit 1919. The auto industry had a massive problem. They'd mastered mass production with the Model T, but the market was saturated. Only the wealthy could afford to pay cash, General Motors, and a man named Alfred Sloan. GM's cars were more expensive than Ford's, and they couldn't sell enough. So in 1919, they created something revolutionary, the General Motors Acceptance Corporation, or GMAC division. This wasn't just a finance company. It was a radical new idea. The idea was, buy this car not with money you have, but with money you will have. For the first time, the average American could afford a more expensive car by stretching payments over time. Every competitor had to follow suit or die. Installment debt became the new normal, and this changed everything. The focus for the salesperson and for you, the buyer, shifted from the total price of the car to the monthly payment you could stomach. That allowed car prices to creep steadily upward because the pain was deferred and diluted. A cycle was born. You'd trade in your old, paid-off car, roll any remaining debt into a new, larger loan on a more expensive car, and repeat. Treated for life. The American consumer was transformed in that moment from an owner to a perpetual renter of their own vehicle. From the bank, Phase brand transportation became a permanent, recurring monthly expense, not a one-time purchase. The lesson is that car payment culture wasn't an accident. It was a deliberately engineered system to maximize corporate profit by leveraging your future earnings. This is the birth of the wealth vortex. Now you might be thinking, okay, Bobby, that's a nice story about 1919, but how does that apply to my actual life in 2025? Well, look around you. This engineered dynamic is everywhere. Let's take a detailed example. Meet Emma. She's 22, just landed a $55,000 a year job. She decides to invest in a reliable car, a new $35,000 SUV. With a $5,000 down payment, she gets a 7% loan for 72 months. Her payment is $502 a month. She budgets for it, it seems fine. But that car loses 20% of its value the first year. In 4 years, she owes $18,000 on a car now worth only $15,000. She's upside down. Then life changes. She gets a better job in the city and needs to move. Her new apartment with a garage costs an extra $200 a month. Suddenly, between the $500 and $2 a month, $150 for insurance, and parking, her transportation costs nearly $900 a month. Here she's trapped by the payment she could afford. To free up cash flow, she feels forced to trade in the SUV, roll that $3,000 of negative equity into a new, cheaper car loan, and restart the clock. The cycle deepens. Or take Mike, who's 35 and finally pays off his sedan. Instead of enjoying 5+ years of no payments, he sees the paid-off car as old. Favor Husk Aiden as a down payment on a $50,000 truck. New payment, $750 a month for 84 months. He just traded a decade of financial freedom for a new hood ornament. And it's everywhere. The family minivan payment, the luxury lease for image, the cheap $299 lease that never ends. This is what we call the wealth vortex potential into a predictable monthly revenue stream for someone else. Let's perform a brutal audit of this vortex. Let's call this person Jordan. Jordan is 30, makes $75,000 a year, and buys a new sedan for $42,000. He gets what seems like a great rate, 5% for a 6-year loan, 72 months. His payment is $676 a month. He thinks, I can afford that. That's the starting number, what everyone sees. Now, let's uncover the true cost over a 10-year period, because he'll likely do this again. First, there's the depreciation sinkhole. You're paying loan interest on top of the car's value evaporating. In 5 years, that $42,000 car is worth about $17,000. Behavior you've incinerated. $25,000, so our running total of true cost is now $25,000. But that's the easy math. We all know cars lose value. Now we have to subtract the compound interest assassin. This is the core of the vortex. Every dollar sent to a car payment is a dollar that can't be invested. If Jordan took that $676 payment and instead invested it in a broad market index fund, averaging a conservative 8% annual return, for those same 6 years, that money would grow to $60,112. That's not money he spent, that's money he never got. So our total cost is now the $25,000 depreciation plus the $60,112 in foregone growth. That's $85,112 for his first 6-year cycle. But we're not done. Then there's the restart penalty. After 6 years, his car is worth maybe $12,000. He uses it as a down payment on another $42,000 car for the next 4 years. To get to our 10-year window, he's still making payments. That's another $483 a month for 4 years. That isn't being invested. The lost growth on that is $27,420. New total, $85,112 plus $27,420 equals $112,532. And it gets worse. Then there's the murdered snowball. This is the darkest cost, $60,112 he didn't invest in year 1. If he had invested it, it wouldn't just sit there. It would keep compounding for the next 30 years until he's 65. But $60,112, left alone at 8% for 30 additional years, becomes $604,807. So let's add it up. The initial decision triggers a chain reaction that over a lifetime of car payments doesn't just cost you the price of the cars, can systematically incinerate between $1, $5, and $2. $3 million of your future compounded wealth. That's not a typo. A $676 monthly payment is actually a $1 million decision. Think about that for a second. And we haven't even touched on how pervasive this is. According to the Federal Reserve in 2023, total outstanding auto loan debt in the U.S. has soared to over $1. $6 trillion. The average new car loan amount is $40,366. Stotted P27 report from Edmunds shows the average monthly payment for a new vehicle has hit a record $738, with the average loan term stretching to 70. That's nearly 6 years of payments. LendingTree data from 2023 shows a shocking 38% of new car buyers have a monthly payment over $750, and 17% are over $1,000 a month. By behavior, This means we have collectively normalized paying a second rent or mortgage payment for a product that loses value by the minute. And before you say, "But Bobby, I need a reliable car," I agree. 100%. The question isn't about needing transportation, it's about how you finance it. The Bureau of Labor Statistics shows the average American household spends over 15% of their income on transportation, most of it on car payments and operation. That's more than they spend on food. That's the equivalent of taking one full day's pay every single week and setting it on fire in your driveway. This is where it gets really interesting. The wealth vortex is a self-perpetuating cycle. When you take on a large, long-term car payment, it severely limits your monthly cash flow and savings rate. That limited savings rate then forces you to finance your next car, often rolling in negative equity, and that makes your next payment even more destructive, further crippling your wealth-building engine. You're running in financial quicksand. It's like being on a treadmill that's set just a little too fast. You're sprinting just to stay in place, never able to build up the speed or the runway to actually jump off and get ahead. And here's what really gets me. The auto finance industrial complex relies on your perpetual participation in this cycle. They profit on you focusing on the monthly payment, depend on you feeling that a new car is a reward or a necessity. They literally budget for your trade-in, knowing the depreciation curve better than you ever will. When you do the opposite, when you buy a quality used car with cash and drive it for 10 plus years, you become a bad customer for them, but a brilliant CFO for your own life. The system wants you laser focused on the make, the model, and the monthly payment, because that hides the truth of the total cost and the catastrophic opportunity cost. This isn't just bad personal finance. For millions, this is predatory. This is designed. This is a wealth extraction scam, wrapped in aluminum and chrome. Now I can hear the objections already. "Bobby, used cars are unreliable. I can't afford constant $2,000 repair bills." And look, I get it. That seems reasonable. The fear of a surprise repair feels massive and immediate. But you're already committing to a guaranteed $40,000 loss with a new car through depreciation and interest. $2,000 repair is a rounding error in that equation. With the thousands you save from having no payment, you can create a car repair sinking fund and still come out hundreds of thousands of dollars ahead. You might also be thinking, "But I need a safe car for my family." A 3-year-old certified pre-owned car from a reputable brand has the exact same safety features as the new model from 3 years prior. You're paying 40% less for the same metal and the same airbags. The problem isn't transportation or safety, the problem is financing. You can solve for safe, reliable, and dignified without enslaving your future earnings to a bank. Behavior. So what do you actually do with this information? How do you escape the trap? Let me give you something practical. Strategy number 1, the drive it into the ground protocol. Your mission is to have as few car payment years in your life as humanly possible. This works because it maximizes the period where your monthly cash flow is free to invest, finally breaking the cycle. Here's how to implement it. First, finish your current loan. Then, keep driving that car for 3, 5, 7 more years. Second, the very next month, take the former payment amount and auto-transfer it immediately into your investment account. You're already used to spending it. Third, perform meticulous, scheduled maintenance. This is your new car payment. Fourth, save for your next car in a high-yield savings account during this glorious no-payment period. For example, when Jordan's $676 payment ended, if he invested it for just 8 more years, that pot grows to about $97,000. He can now buy his next car with cash. Here's strategy number 2, the cash-only car rule. You never ever borrow money for a depreciating asset. This works because it forces you to live within your savings means, not your credit means, eliminating interest and keeping you in cheaper, value-stable used cars. Implementation is straightforward. 1, define your separate car fund. 2, buy the best, safest, most reliable car you can with the cash you have. No exceptions. 3, as you drive it, continue funneling money into the car fund for repairs and your next purchase. You have $15,000 saved. You buy a clean 5-year-old Camry for $14,500. Own it outright. Your insurance drops. You have no payment. You win. Strategy number 3, the transportation allocation budget. Treat all car costs, payment, insurance, gas, maintenance, repairs as one single transportation line item and cap it at 10% of your take-home pay. If your take-home is $4,500 a month, you have $450 for everything car-related. A $400 payment leaves $50 for everything car-related. Possible. It forces you to find a cheaper, cash-based solution. But the biggest shift is psychological. You have to start valuing your financial independence more than you value the opinion of strangers at a stoplight. Savior, you're not the person with the old car. You're the person with the $97,000 brokerage account and no car payment. Here's what I want you to do this weekend. Savior, pull up your bank statement. Add up your last 12 months of car payments, interest, and extra insurance costs. Now, take that total annual amount and plug it into a compound interest calculator, projected out 30 years at an 8% return. Stare at that final number. That is the first draft of your Wealth Vortex escape plan. I want to leave you with one final thought. This isn't really about cars. It's about autonomy, true freedom. We thought a flashy car meant freedom, but we traded real financial autonomy for a metal cage on a 72-month term where our grandparents saved and paid cash. They saw debt as a risk. We were sold debt as a tool, but it became our master. The people who actually thrive financially aren't the ones with the most impressive car logo. They're the ones with the highest degree of optionality, the ability to say no to a bad job, to take a risk, to retire early, to handle an emergency. That power doesn't come from a high credit limit. It comes from unallocated capital. You can't borrow your way to wealth, but you can save and invest your way to irreplaceable freedom. The Wealth Vortex is powerful, but it only works if you stay on the ride. The moment you step off, the moment you decide your future self's $1 million is more important than today's minor luxury, the entire machine stops. You become ungovernable by the system. That is the ultimate power. You're not broken for wanting a nice car. You're human, and you've been marketed to since birth. This journey is unfair because the trap is invisible. But once you understand the math of the Wealth Vortex, you can choose to stop feeding it. If this video showed you the $1 million price tag of normal, share it with a friend who's stuck in the cycle. Smash that like button so the algorithm fights the propaganda. Hit subscribe for more content that challenges how you think about money. Thanks for watching, and I'll see you in the next one.